Hey everybody, welcome to the morning market briefing. It's Wednesday, February 4th, 2026, and let us be the first to wish a very happy 73rd birthday to Jerome Powell. Tom brought it to our attention that it is his birthday. Hicks looked absolutely giddy from his producer seat. Immediately started writing out an IOU note and looking up the best address to reach Jay Powell. To offer a few hug coupons. So, Jay, if you get the letter from super producer Hicks, we got some hugs waiting on you. And he looks fired up over there. Just absolutely giddy. We are going to talk about the Fed, but I want to open, Ben. AI is cannibalizing software companies.
Yeah, it's like
they're eating themselves from the inside.
It's crazy. I mean, we saw a massive, it was probably the biggest software collapse that I've seen yesterday. I mean, it's been building for some time and then it just collapsed. Everything in software was down. There's a thinking that it's really twofold. The first is that you're going to have a bunch of agents at these tech companies or any company really, rather than seats subscribing to a company like Salesforce. So
AI
for example, like if we have a marketing company, maybe we can do the same amount of marketing consulting for people with 5 people than we could with 10 people, which means we only need 5 Salesforce licenses rather than 10 Salesforce licenses. If you're an IT company, maybe you can do it with half the staff, so you need half the ServiceNow subscriptions. If you're a Delta, maybe you can have half the number of pricing analysts that you have, and therefore half the number of Microsoft subscriptions. So that's the thinking that's kind of in the zeitgeist out there. It is unsubstantiated by the data. I mean, all these companies are reporting earnings. All of them have extraordinary retention rates and are providing good guidance. That is unsubstantiated by the data. I don't fully buy into that yet, but we are seeing more and more news about layoffs.
And it wouldn't contradict a major theme that we've talked about, which is, hey, GDP may do pretty well, but there's going to be some decoupling as it relates to the employment picture.
And I think, and I agree, and I completely agree with that. I also think that, people thinking that this is going to go down by 20, 30, 40% in terms of number of employees, I think that's foolishness. Maybe it's 5%, maybe it's 10%. And these companies can get it back on pricing by saying, well, this is smarter technology. Because now we have AI in our software, you're able to be more productive. You don't have to have that employee. So I'm less concerned about that. What I think is probably more concerning is the amount of money that is being spent on AI, and we're not really seeing a return on investment. And it's really coming all to a front right now with this latest funding round for OpenAI. They're really struggling to cobble together the money. You have NVIDIA, who was in and then they were out, and now they seem like they kind of came back in with $20 billion. They're trying to get Amazon in for $50 billion, SoftBank in for $30 billion. And the problem is, what I think changes this, because right now Adobe's been in a bear market for 2 years. Microsoft had good numbers and the stock went down 10%. You have a lot of companies that are reporting good results, but you're not going to get a shift in the narrative until you can force that shift in the narrative. What forces that shift in the narrative? You've got to get free cash flow. You've got to get revenue growth exceeding that of your capital spending growth. The problem is we're a ways from that. People are talking about physical AI. People are talking about, maybe in 5 years when we have artificial general intelligence. The market's not waiting that long. What the market wants is they want for revenue to eclipse CapEx sooner. So you got to accelerate that time to profitability. 2 ways to do that. You can accelerate revenue. We're starting to see OpenAI look toward advertising as a way to do that. Or you can scale back your ambitions and scale back your CapEx. And I think that is going to be the next shoe to drop. I think that you're seeing companies trying to cut other expenses outside of AI. Oracle's talking about laying off 20% of its workforce, talking about selling out a $30 billion acquisition they made a few years ago. I mean, they're selling everything that's not bolted down to AI, which means what's left, they're going to start throwing out AI. And I think what it would look like is they have this massive deal that OpenAI did with Oracle, hundreds and hundreds of billions of dollars. Why not cut that in half? Say, look, you know what, we're going to accelerate the time to profitability. The absolute dollar return on investment is going to be lower, but the actual percentage return, exactly. And I think that's got to be the end game. The problem is OpenAI has an IPO they need to do. So they don't want to play ball because you're going to get the highest valuation when you have the biggest ambitions possible. If you're scaling back ambitions before an IPO, that's not a recipe for a successful IPO.
It's interesting, too. It reminds me a little bit of, going back a decade when we talked a lot about Amazon. With Amazon, they had Amazon Web Services. They obviously had the retail business. They kind of had their toes in all these different ponds. They were doing a little bit of everything. And the question really was, at what point do they time the switch to profitability and really start generating free cash flow? How do they manage that? Because the market prefers the aggressive growth story over profitability because it kind of has that audacity of zero where it's like, who knows how much profit could be made? And in the market's eyes at that time, the possibility of so much profit was more attractive than an actual amount of profit would be. And it's a tightrope that they have to walk to figure out, okay, when do we flip this switch? And it seems like the market's kind of forcing these companies' hands on that now.
I couldn't agree more. And I think with Amazon, they ended up having a successful thesis.
Yep.
I think you've had some companies, and people say, well, don't question these management teams. They know way more about AI than any of us. And that's true. But, how many times have we seen this groupthink take place in some of these spheres? And they say, well, we just have to buy whatever. And we're starting to hear this. We just have to build whatever we can because something good is going to happen. I just know something's good. The more money we spend, the more good stuff is going to happen. We heard that with electric vehicles a few years ago.
Peloton.
And yeah. But everyone, it was so fashionable. Everyone had to have an electric vehicle strategy. The stocks zoomed up. And then people were like, you guys are burning through gobs and gobs and gobs of cash. And when did the stocks actually finally start going up again? When Ford took a $20 billion charge and said, we're going back to internal combustion vehicles. And now GM's back to $80 a share. It couldn't get over 40 there for a while. You saw the same with streaming. Like Disney's like, we got to get into streaming. Disney announces Disney Plus, stock rockets, and then it's like, man, these guys are spending gobs and gobs and gobs of cash and not generating a return. And then we saw the same thing. Zuckerberg fully believed. Tim Cook fully believed in Vision Pro. Zuckerberg fully believed in the metaverse. Zuckerberg changed the name of the company. He believed in it so strongly. Spent gobs and gobs of money. And when did the stock start going up again? When he said, we're canning this metaverse thing. We're going to focus on the year of efficiency. And the stock started going up. And my thinking is we're going to see something happen with AI that's similar to that. And that is, guys, let's take a step back and let's actually make money from this.
Bold move for a business out there. Anthropic raising, essentially tendering an offer out to employees at a $350 billion valuation. I'm with you, Ben. That seems a little low given just the surrounding dynamics.
And I think Anthropic is more useful. I could see myself paying for Anthropic before I could see myself paying for ChatGPT.
Yeah, OpenAI just seems like, I don't know, maybe this is tinfoil hat. Sam Altman's just trying to get a payday. There's lots of rumors and sort of this guy's a bad guy vibes around the entire space. They were supposed to be for the better of mankind, nonprofit. Now they're exploring ads. They're trying to grow as big as possible. They're trying to IPO. I don't know a lot of nonprofits that are publicly traded. Elon Musk is suing him because he invested under false pretenses. Who's to say there haven't been a lot of other people who put a lot of money into that thing under false pretenses? So,
and we know from recent government past, is that when you've got hundreds of billions of dollars floating around, it's very easy to skim a few $100 million or a couple billion from the top to put in my own pocket.
But once it's IPO'd, it's like the money's made, you know.
Yep, you're done. Tom, I want to talk Fed policy a little bit. We gave the birthday shout out and the promise of hugs to Jay Powell. Stephen Moran sticking around though, staying.
Yeah, so he resigned from his White House position, which was such a huge conflict of interest that everybody made a huge fuss about for about 5 minutes before he got on the Fed, and ultimately, I would argue, made some good progress towards the Fed being a thinking body as opposed to just doing whatever consensus Jay Powell came up with off the top of his head, be it by looking at bad data or making up data or pretending that there was no inflation or that pretending it was transitory. So I think there was a lot of good progress there, but it seems like the plan now is for Stephen Moran to stay. He took over for Adriana Kugler. I want to say it was like September, August. The question now becomes, so Jay Powell's bid as the chairman of the FOMC is done, but he does not have to leave. There's been a lot of questions about, hey, are you just going to return, be a voting member of the Fed, take a seat, stay on? And so that is sort of the curveball here, which is that if he does that, there's going to be too many people. There's only so many members of the Fed. So I think the move here is if Moran stays and then Jay Powell goes to stay, then the possibility is basically to have a plant in there so Stephen Moran can exit and then Kevin Warsh can come in. So that way the numbers true up. So if he was to exit, then in theory Jay Powell would take his seat, and then there'd be a little bit of a weird moving day when Kevin Warsh comes to town. And so I don't know. I think it's interesting. I think Warsh is the right guy. He's potentially the right guy. There's been a lot of talk about how people are starting to put on heavy steepener trades because of Kevin Warsh, which would indicate that they thought that the short end of the curve is going to stay low, the long end is going to blow out. I don't see that happening necessarily. I mean, we're already insanely steep. I mean, relative to my entire career, we're about as steep as we've been in a long time. I think it's just going to it's going to come down to who's going to be on the Fed, and I think that Stephen Moran staying on helps actually maintain. I mean, call me crazy here, but Fed independence, which is that each independent person on the Fed has a say. It seems that in the last 20 years, sort of after the Greenspan model, everyone was like, we're just going to do whatever Greenspan says. And that set a precedent that's now so far gone that everybody jumped on and was like, whatever the Fed chair wants to do, we do. And that's been broken in the last 2 years, where suddenly members of the Fed are coming to the table with their own data. They're coming up with their own ideas. They're disembarking from this train ride where we all follow along. And I think that that's a positive thing. So Stephen Moran staying on is important, I think, just for the healthiness of the discussions within the Fed. But ultimately, who's going to be there in the next couple months still kind of remains to be seen.
Yeah. And what's really interesting, too, is that it kind of it's going to be a really interesting experiment with game theory, too, because does Powell leave and open up that spot for Warsh? And therefore, instead of just having we had two dissenting votes at the last meeting, Waller and Moran. Bowman said that she could have dissented if she was pushed to it. And then you'd have Warsh. So all of a sudden, your two dissents become four, and you start to Warsh only needs to get two more people on his side in order to get through rate cuts. If Powell stays, then you have to replace Moran. But Powell also, he's 73 years old today.
Yeah, that was the reason for looking to see when his birthday was, because I wasn't quite sure how old he was, and so I looked it up, and sure enough, today's his birthday. So what are the odds?
It's interesting you talk about the steepener trade, which is basically Warsh would cut interest rates, and the long end would remain high. I think that's I think a lot of people are assuming that. A lot of finance minds are assuming that. But bear in mind that Bessent and Druckenmiller and Warsh Bessent and Warsh are both under the tutelage of Druckenmiller. And Bessent thinks that we really need to get long rates down.
Yep.
And I think that Warsh would probably agree. And therefore, I think that the steepener is probably unlikely in terms of what Warsh would want. So I would say probably a parallel shift down, if anything. You could even have a flattening if these jobs numbers continue to come in weak.
Yeah, I think it's more likely that we kind of stay where we are on the short end, maybe come a little bit lower with 2 to 3 cuts, maybe. But I think all of the pressure from the Fed that they can drum up is going to be pushing the long end down. And if inflation comes in, we were looking at the Trueflation data on Bloomberg the other day. Trueflation says we're at 97 basis points on real inflation right now, based on their non-BLS calculations. If that's the case, then the long end should come down like a rock, because it's basically anchored to long-term inflation expectations. And right now, if you think, oh, we're going to be at 3.5%, well, you should get probably 2% over that for taking a lot of risk on the long end. And that's where we are. We're like roughly at 486, 487 on the 30-year. Well, if that's really one, then maybe we should actually be at 387. And in which case, we're looking at some pretty big gains in long bonds. And the risks just are not the same. It shocks me how few people know and understand bond math, but it's a dead industry. It died with QE and QE2 and zero interest rates. And there are very few high-level thinkers in that space right now. And I think that you need to be really thinking about the risks and rewards. I know I've said it a million times, but those people at Silicon Valley Bank were not thinking about bond math, and it blew up the bank. And so I think that the opposite is true. The seesaw flipped the other way. Your rewards are very high. Your risks are very low. And I think that gives you a lot of cover to start adding long bonds and looking for a scenario where in 6 months to a year, the 30-year drops.
Ben, you alluded to employment. What are we seeing data-wise coming through?
We had the ADP employment number, which we try to gloss over a lot of times because I don't think the data is that good. But we don't get BLS employment data this month, because of the government shutdown that is now over, I think, or about to be over. So they're not going to release that on Friday. What was interesting is the head of the ADP said, we've seen a continuous and dramatic slowdown in job creation for the past 3 years. So she did note that wage growth has remained relatively stable. And I think that's exactly what we've been talking about, this K-shaped economy. There are going to be people who don't have jobs anymore, and the people who do have jobs are going to be more productive and therefore more valuable to their organization. And I think that's exactly what we're seeing, and it's writ large here in this ADP employment number. And I think we have the data up on the screen. And what's interesting here is that the biggest cohort of declines in jobs are happening at the largest companies, which is something that we've seen anecdotally, but it's interesting to see that it's backed up by the data as well. We created 22,000 jobs according to ADP in the private sector last month, but 74,000 of those were in healthcare. So if you do the math, 52,000 job losses outside of healthcare. So not a good employment number. And I just wonder, at what point does the Fed start to wake up and take a look at this data and say, maybe the economy should be judged. Maybe we should actually look at what the dual mandate is, which is price stability and maximum employment, not GDP growth. They're so anchored to GDP growth. They're so scared of seeing a 4 or 5% number on GDP because they're like, oh, the economy's running hot. They should not care about the economy. Like from economic growth perspective, they need to care about inflation and they need to care about employment. And employment's going the wrong direction.
I mean, it's talk about the mission creep. The mission creep is no recessions. That's probably the biggest error that the Fed has made with mission creep, is that anytime there's just a whiff of stinkiness in the GDP number, they start cutting rates. They start implementing QE. And I think Warsh gets that. I mean, he's obviously an apologist for his own moves on QE. And I think that, I mean, even the recession that we did have, let the record show, we did have a recession in summer of 22, that they retroactively went back and said, actually, the second quarter that was down was just flat. You know, that's a healthy thing to do. And like 22 was miserable in a number of different ways. Markets, bonds, you name it, everything was down. But things have been pretty good ever since. And I think that if you let that maybe be more extreme, that we would have had a lot of these people get shaken out of those jobs earlier. You know, we've had like the natural thing is just let the pain happen. It makes you stronger. You know, there's Nassim Taleb, who lives a few miles from here, famous epistemologist, financial guy. You know, it's called being anti-fragile. You know, if you have systems that, you know, are rigid and you can't let anything hurt them, and, you know, as soon as there's a bump, then they fall apart completely. Think of the more you run a washing machine, the weaker it gets. But if you go in the gym, 2 suites down in our office and you do deadlifts every day, you're putting an enormous amount of pressure on yourself. But guess what? You get stronger. And that's how economies work too. That's how natural systems work. And I just think that we need to let a natural system be, as opposed to create these very fragile systems that the more you work them, the more fragile they get.
And by the way, you might get injured deadlifting, but you're not going to drop dead.
Correct. Yeah. The washing machine.
It's a real misnomer.
Eventually will die.
Yeah.
You continue to stress it and you replace parts and you do everything you can. It still will eventually not work. So that's something to consider.
And you'll miss her. Texas Instruments buying Silicon Labs, $7.5 billion, Ben. This is a company that offers wireless connectivity for a whole array of products, similar to ADI, but maybe lower scale.
I'm
What's
telling
the
you.
angle? This seems like an acquisition that would have happened in 2011.
I mean, it's crazy when you think about the price. So first of all, Texas Instruments has been struggling to get growth. They've been underperforming relative to analog devices. They've really gone down market. They lack the high-end technology, and I think this is kind of like throwing the white flag in that market, because Silicon Labs provides a lot of chips, chip design for things in wearable devices, smart home, the Internet of Things. Remember that?
I mean, what year is it?
Lighting, things like that. And I think that Texas Instruments has probably had its eye on this for a long time. And then, they were talking to their friends at Goldman, and Goldman was saying, and they were saying, we should probably think about making an acquisition to re-energize growth. And Goldman said, well, you're probably right, especially if we get paid on it. And they said, man, this company, Silicon Labs, it's really been good. What do you think we should offer for it? Well, think about the strategic benefits that
How
you
much
get.
cash do you have?
Yeah. And they're like, well, we have $7.5 billion in cash. And they're like, well, $7.5 billion sounds about right. It's only like a 80% premium to the stock price. I mean, this company topped out at 210, and it has been in slow-moving downward spiral for the last 5 years. It's now at 136, or it was at 136. Texas Instruments just offered $231 cash, not stock, cash. And I think this is just another piece of evidence that Texas Instruments has really missed the plot. But also, if you are making an acquisition, if you're selling a company, go shop yourself to Goldman Sachs.
Yep.
Because they just want to get a deal done.
Yeah,
It's like the old realtor model. It's like what was it? Super Freakonomics.
Yep.
When they were saying the realtor just wants the deal done. Like whatever's going to take to get the deal done, they just want to get it done. So, I mean,
they routinely sell their homes for more than they'd sell your home for.
I think it says a lot that Silicon Labs, they didn't hire Goldman. They hired this company called Catalyst Partners, Catalyst with a Q. Like, I think that they were just like,
Quite a list.
I think they just basically said, look, we need an advisor, but how can we say no to this deal?
Yeah.
And they didn't.
And rightfully,
Yeah.
Quatalist said do it.
Yeah, if you're wondering, it's like kind of like Cutter. We don't say Quatar.
How do we get that gig? How do we become the advisor for someone
That's getting bought for too much money.
Yes.
It's the dream. I want to talk earnings a little bit. I want to highlight Chipotle. Big plans for Chipotle. If you're a regular listener to the call, you probably know how the boys feel about Chipotle. But the big year coming up, they do think they can get 0% growth, which would be an improvement from a decline of 2.5%. And the plan is really quite simple on this. They are doing a national search for a chief marketing officer. And in addition to that, they think they can boost same-store sales just by focusing on employee training, equipment upgrades, catering improvements, more limited time offers, and changes to the rewards and marketing program. So simple playbook. We're going to change everything. And if we do that, we think we can be flat in our sales. So shout out to Chipotle, down 5%. But, I mean, it is wild that they are only down 5%, in my opinion, when you look at some of the quality of earnings that have been put out this quarter, and companies have just gotten absolutely dumped.
I think we're just continuing to see pricing pressure in this whole edifice. There was a time where Chipotle could throw out 5%, 6% pricing every year, and that was just part of the business model. Like, you were starting at a 5% comp every year just because of pricing, and now it's negative. I think they can get 1% to 2% of pricing this year, but I don't know about that. But Pepsi, I mean, cutting prices on a lot of its products. Clorox was talking about it today. You also had Mondelez, even Eli Lilly. I mean, we have a chart on the pricing on Eli Lilly here. Pricing at Eli Lilly was down 7%. They had a tremendous quarter, but it was driven by volume. If you look at Starbucks, they returned to positive comps, and Brian Niccol, the old CEO of Chipotle, gets it. He's like, we can't push pricing anymore. We got to get on transaction growth, and he's not doing pricing. And he says pricing would be judicious, surgical, and I think that's a theme, and it's very different than when we had the massive inflation. I remember I was at a talk down at Georgia Tech with the former Atlanta Fed president, Dennis Lockhart, and he said, for the first time in a while, I'm seeing that people have pricing power. Companies have pricing power. Well, companies don't have any pricing power right now, and I think that the Fed would be wise to pay attention to that.
All right.
You know who Chipotle should get to be their chief marketing officer? A little guy named Alex Hormozy. For those who are chronically online, he's like a bearded guy who is always talking about his $100 million deals. He's jacked. He eats a lot of Chipotle.
Yep.
Talks about how you shouldn't waste your time making food. You should just go to Chipotle. That's your guy. You need to plug that in. I don't know how he made his money exactly, other than being an Instagram influencer that's risen to prominence in the last couple of years, but that's your guy. If you want to lean into the bro science, go where the vibes are. I think he's your choice. So go look him up. He's a very hairy, jacked man.
The search is over. We found him for you at Chipotle.
He's big on sandals as well.
Yep.
Because you can wear them anywhere. He likes to lift in his sandals, which I think is an insane move.
Yes.
But hey, listen, he's jacked. You know, who am I to say he can't lift in his sandals?
I mean, yeah, I wouldn't fight him.
So there you go. That's my official input.
There we go. All right, we'll wrap it up there. We'll be back tomorrow. I think just Tom on the call in the morning. Talk to you guys soon.